If I had to start my investment journey from scratch in 2026 with $0 in my portfolio, I would only buy 3 ETFs. Not 10, not 50, just 3. In today's video, I'm breaking down exactly which ETFs I'd pick, why these specific funds can build serious wealth, and how much you could realistically accumulate over time. If you're serious about building a portfolio that actually works, keep watching. Now, before we get started, this is not financial advice. I'm just sharing educational content about dividend investing. The content in this video is for informational purposes only and should not be considered as investment advice. Real quick, my personal investing philosophy. Before we dive into the 3 ETFs, let me share something important about my investing approach. I won't wait until I have $1,000 before I start investing. Here's the thing, I've developed the habit and I've been consistent with small amounts. Whether it's $10, $50 or $100, I invest what I can every single month without fail. This consistency is more powerful than any stock picking strategy you'll ever learn. According to data from Vanguard, investors who contribute regularly through dollar cost averaging build wealth faster than those who try to time the market with lump sums. It's not about how much you start with, it's about starting and staying consistent. Now you might be wondering, why only 3 ETFs? Can't more diversification be better? Here's the reality. Over-diversification actually dilutes your returns. When you own too many funds that overlap with each other, you're essentially paying multiple fees for the same exposure. The strategy I'm sharing with you is called a core and satellite approach. You have one strong core holding that gives you broad market exposure, and then 2 satellite holdings that add specific types of growth or diversification. This keeps your portfolio simple, cost-effective, and easy to manage. You're not constantly checking 20 different funds or second-guessing your decisions. According to research from Morningstar, the most successful long-term investors typically hold between 3 to 7 funds maximum. More than that, and you start seeing diminishing returns. So let's get into the 3 ETFs I would buy. ETF 1, Vanguard Total Stock Market ETF, ticker symbol VTI. The first ETF I'd buy is the Vanguard Total Stock Market ETF with ticker symbol VTI. This would be my core holding, and it would make up about 60% of my total portfolio allocation. So what exactly is VTI? VTI tracks the CRSP US Total Market Index, which includes nearly 100% of the investable US stock market. We're talking about over 3,600 individual companies ranging from mega-cap giants like Apple, Microsoft, and Nvidia, down to small-cap and mid-cap companies that most people have never heard of. The beauty of VT is total diversification across all sectors and all company sizes. You're getting technology, healthcare, financials, consumer goods, energy, everything in one single fund. And the expense ratio is just 0.03%, which means you're only paying $3 per year for every $10,000 invested. That's incredibly low. Now let's talk about performance, because past performance doesn't guarantee future results, but it does give us context. Over the past 10 years, as of October 2025, VTI has delivered an average annual return of approximately 13.97%. You had invested $10,000 into VTI 10 years ago and never added another dollar, you'd have roughly $36,000 today. But here's where consistency really shines. If instead of investing $10,000 once, you invested just $200 per month for 10 years into VTI, at those same returns, you'd have accumulated approximately $46,000. That's from contributing only $24,000 total. The power of consistent investing and compounding is real. VTI also pays quarterly dividends with a current yield of around 1.15%. Those dividends get automatically reinvested if you set it up that way, which accelerates your wealth building even more. ETF 2, Vanguard Growth ET, ticker symbol VE. The second ETF I buy is the Vanguard Growth ETF with ticker symbol VOO. This would be my growth satellite holding, making up about 30% of my portfolio. VUG tracks the CRSP US Large Cap Growth Index, which focuses specifically on large US companies that are growing faster than the overall market. The top holdings include companies like Apple, Microsoft, Nvidia, Amazon, and Tesla. These are the innovation leaders, the companies pushing technology forward and capturing massive market share. The expense ratio for VUG is 0.04%, still incredibly low. Now here's where it gets interesting. VUG is more volatile than VTI because growth stocks swing more dramatically. But over the past 10 years, VUG has delivered an average annual return of approximately 17.26%, significantly higher than VTI. If you invested $200 per month into VUG for 10 years at that historical rate, you'd accumulate around $55,000 from total contributions of $24,000. That's exceptional performance. However, you need to understand the trade-off. During market downturns, VUG typically falls harder than broad market funds. In 2022, when the market crashed, VUG dropped about 35% from its peak. This is why VUG is a satellite position and not my core. It adds growth potential but comes with a higher risk. If you're young with decades until retirement, that volatility is acceptable. If you're older or more risk-averse, you might allocate less to VE and more to VTI. ETF 3, Vanguard S&P 500 ETF, ticker symbol VOO. The third ETF I'd buy is the Vanguard S&P 500 ETF with ticker symbol VOO. This would make up the final 10% of my portfolio and serves as additional large cap stability. Now, you might be asking, why VOO when I already have VTI? Great question. VOO tracks the S&P 500 index, which is the 500 largest US companies. These 500 companies actually make up about 82% of VTI by weight. So yes, there is overlap. The reason I include VOO is for additional weighting toward proven, stable large cap companies. VOO has slightly outperformed VTI over recent periods because large cap stocks have been on fire. Over the past decades, VOO has returned approximately 14.55% annually compared to VTI's 13.97%. The expense ratio is identical to VTI at 0.03%, and VOO also pays quarterly dividends with a similar yield of around 1.15%. VOO is actually the most popular ETF globally, with over $500 billion in assets under management. That massive size means incredible liquidity, tight bid-ask spreads, and rock-solid stability. Some investors debate whether you need both VTI and VOO since they overlap so much. My reasoning is that the 10% allocation to VOO tilts my portfolio slightly more toward large caps, which have historically provided better risk-adjusted returns during volatile periods. But honestly, you could skip VOO entirely and just split your money between VTI and VUG if you want even more simplicity. So how do you actually buy these ETFs? If you're in Nigeria, Ghana, or South Africa, I highly recommend checking out the Bamboo app. All the details are in the video description below. Bamboo allows you to invest in US ETFs like VTI, VUG, and VOO directly from your phone with as little as $10. They offer fractional shares, which means you don't need hundreds of dollars to get started. You can literally invest $10 and own a piece of all three of these ETFs. The platform is designed specifically for African investors and makes dollar cost averaging incredibly easy with automated monthly contributions. If I started from zero in 2026, these are the only three ETFs I'd buy. VTI for total market exposure, VUG for growth potential, and VOO for large cap stability. Keep it simple, keep costs low, and most importantly, stay consistent with your contributions. Don't wait for the perfect moment or until you have thousands saved up. Start small, start now, and let time and compounding do the heavy lifting. I've developed this habit and it's transformed my financial life. the same can happen for you. That's it for today's video. If you found this valuable, smash the like button. And let me know in the comments which of these 3 ETFs you're most interested in, or if you'd choose different ones. I'll see you in the next video.